Welcome to a deep dive tailored just for you. Today, we're tackling one of the most significant names in the Turkish industrial landscape, the Ostim Group. Our mission is to take their summary financial statements and activity reports for the first 9 months of 2025, so that's January through September, and really figure out what matters. We're looking for those high-impact insights hidden in data that's been, warped by hyperinflation, ambitious exports, and some massive structural changes. It's a complex picture. Okay, let's unpack this.
Yeah, and for anyone diving into this data, the first thing you have to get your head around is the accounting context. These results are prepared under Turkish financial reporting standards, and that mandates a pretty extreme adjustment, hyperinflation accounting.
Hyperinflation accounting. Why is that?
Well, it's because cumulative inflation over the last 3 years in Turkey just blew past 100%. This is, this invisible hand that warps the reporting. It adjusts every single number to the purchasing power of September 2025.
So it means you can't just look at last year's numbers and this year's numbers side by side.
No, not at all. Direct comparisons are completely useless unless you adjust for this huge methodological shift.
That sets the stage perfectly. Before we even touch the group's balance sheet, what was the operational environment like for a manufacturing company in Turkey during that time?
Context is absolutely everything here. As of September 2025, the economy was just defined by this constant, high-level price volatility. You had yearly consumer price inflation hovering around, 33%? And the costs producers were paying were up about 26%. This constant motion makes any kind of strategic planning incredibly challenging.
That sounds like a recipe for pessimism. Was the general feeling among businesses pretty gloomy?
It was, yeah. The overall economic confidence index was below 100, which signals general pessimism about where the economy's headed. But, and here's a major contradiction, the manufacturing sector itself was actually slightly optimistic, just over 100 on their confidence index.
Interesting. So the general mood is down, but manufacturers are sort of holding steady. What does the actual activity show?
The operational reality is a bit more cautionary. The real sector's capacity utilization rate, so how much of their factory capacity they were actually using, was around 74%.
And that's a drop, right?
It's a small but notable drop from the previous year. And even the Purchasing Managers Index, the PMI, that also indicated a continued sector slowdown. Volume is contracting.
So that creates a difficult operating environment.
Exactly. If you're a manufacturer in this space, you can't rely on just selling more. You absolutely have to rely on selling smarter.
And if you're building anything, you're also facing some brutal costs. I saw the construction figures.
Oh, absolutely. Construction is a pressure cooker. The construction cost index was up significantly year on year, and that was driven most sharply by labor costs, which jumped over 30%. When you combine all that high inflation, tight capacity, rising labor expenses, any industrial group needs extreme specialization just to survive.
That sets the necessary dramatic tension. So let's move to the financial headlines, because the revenue number is really misleading. If you just glance at the profit and loss statement, the top line, the revenue, it looks like a disaster. It essentially halved, dropping from 636 million TL last year to just 306 million this year. So what's the real story?
The real story is that the group is operationally much, much healthier than that headline drop suggests. That massive halving requires two major adjustments, which we can just call accounting noise. First, the previous year's revenue included a really large non-recurring item, around 243 million Turkish lira, from real estate sales. That was a one-time cash injection, not core industrial activity.
Okay, so once we strip out that one-off sale, the drop is less dramatic, but it's still there.
Correct. And that remaining drop is largely down to the second factor, the negative effects of the hyperinflation accounting itself, which basically restates all your past revenues downward when you convert them to the current, much lower purchasing power.
Fascinating. So once we adjust for the methodology and that one-time sale, how did the bottom line look?
It looks fundamentally improved. I mean, despite that technical revenue decline, the net loss that's attributable to the parent company significantly shrunk. It moved from a loss of about 151 million TL last year to a much more manageable loss of 49.8 million this year. That is a clear step towards profitability, towards stability.
Now, here's the really technical but super impactful part. You mentioned the net monetary position swing. That's a massive win in an inflationary environment. For the layperson, what is that? And why did they move from an 85 million TL loss to a 16 million TL gain?
That's where the hyperinflation rules give us this crucial window into their strategy. The group saw a major swing, moving from a massive loss in 2024 to a pretty significant gain in 2025. And simply put, under hyperinflation, debt is your friend, and holding cash is a loss. A net monetary gain means the group successfully held more non-monetary assets, so think real estate, physical inventory, which retain their real value.
Right, relative to their debts, which are just inflated away.
Exactly. It's inflated away over time. It shows very smart balance sheet management. They're basically treating their physical assets as an inflation hedge.
That is impressive stability in such a volatile market. Does this positive trend translate to the broader balance sheet health?
It absolutely does. Their financing structure is just rock solid. The group maintains a very high reliance on its own funds. Their key stability metric, the ratio of equity to total liabilities, remains stable and really robust at 87.3%. They're minimizing external risk in a very unstable time.
But I did note one shift on the balance sheet that, it raises an eyebrow. The immediate cash position looks much tighter. Cash and cash equivalents dropped dramatically from 76 million TL at the end of last year down to 16 million. What was that cash used for?
That's a very sharp drop in liquidity, and it's a necessary trade-off. That cash was deployed heavily into growth and strategic maneuvers, including the huge capital restructuring we'll cover in a bit, and operational investments like their solar power expansion. It really reflects a strategic decision to prioritize long-term asset value and restructuring over having a lot of cash on hand.
So they traded liquid cash for strategic, long-term resilience. That makes sense as a theme. Let's pivot to the operational core then, segment 3. Their strategy is clearly built around high-value manufacturing and export. This is them surviving through specialization.
That is the single most compelling takeaway from this report. The unifying theme is just high added value. They're selling expertise and precision, not just volume. To give you some context, the national average export price for Turkish goods in 2024 was around $1.46 per kilogram. Now look at what their subsidiaries are achieving.
Okay, let's start with Mexis, the heat systems and water tank company.
Mexis's exports are stable, but their prices are incredible. Their average export unit price for heat systems was $4.41 per kilogram, and for water tanks, $2.91.
Wow, that's already 2 to 3 times the national average.
Right. And they are so strategically focused on boosting foreign trade that they established an entirely new dedicated Ostim export office just for that.
A clear commitment to premium product lines. But the numbers from their machinery parts arm, OSP, are even more astonishing.
They really are. OSP's exports held steady, but their value proposition is just staggering. Their average export unit price was $9.13 per kilogram.
Wait, say that again?
$9.13 per kilogram. And the sector average for machinery parts is $4.92. They're nearly doubling the sector average, which proves they occupy this extremely specialized high-margin niche, and they're actively promoting it, attending major international fairs like BAMA 2025.
$9.13 a kilo? That's not selling machinery, that's selling industrial gold. They are embedding so much intellectual property and precision into those parts.
Exactly. And the same story holds for their aluminum casting subsidiary, Gunhan Ostim. We see capacity utilization drop there, which is likely due to external sector constraints like the global automotive slowdown. However, their strategic position is powerful. Their export unit price was $12.07 per kilogram, vastly outperforming the relevant Turkish category average of 75.
$12 a kilo. That specialization is the engine of their resilience, and they're also focusing on internal efficiency and energy self-sufficiency, right?
Absolutely. They're consolidating to save costs. They merged Ostim Kulp, a metal mold manufacturer, into Gunhan Ostim earlier in 2025. The goal is synergy and reducing their fixed cost base. And on the energy front, they're focused on insulating themselves from high utility costs. They've increased their installed solar power capacity on rooftops and land at 2.3 in MW.
So the goal is just to cover their own needs.
That's it. Cover their own consumption with renewable energy, which is a crucial hedge against Turkey's high energy inflation.
And beyond their core manufacturing, they are fostering a wider tech ecosystem through their venture capital fund.
Correct. The Ostim GSYF Venture Fund is investing in new high-potential technology and R&D firms. And crucially, it serves a dual purpose. It helps external companies meet their legal requirement to invest a portion of their tax-exempt gains back into R&D funds. So the whole ecosystem benefits.
Moving on to segment 4, let's look at the financial architecture they're building. They've been very busy shoring up their capital structure.
This is perhaps the most decisive strategic move of the whole period. They executed a major capital restructure, completing a 432 million TL bonus issue. That increased their paid-in capital to nearly 600 million TL. But the truly eye-popping move is the regulatory approval they received to dramatically increase their registered capital ceiling.
How much did they increase it by?
They jumped the ceiling from 765 million TL to a massive 9.9 billion TL, valid through 2029.
9.9 billion. That's a declaration of intent.
It really is. It gives them extraordinary financial firepower for future growth, large investments, or acquisitions.
And it's good to see them cleaning up old liabilities while they pursue that growth.
For sure. They terminated a 60 million TL bank loan guarantee they had provided for a subsidiary's real estate purchase, just because that loan was closed. They're reducing their exposure while, at the same time, utilizing cheaper Exim Bank credit lines to ensure their foreign trade stays competitive.
Their real estate strategy also appears to be a crucial inflation hedge, monetizing completed projects while investing in new ones.
That's the classic pattern. They completed the second phase of that Ergazi real estate project, a revenue-sharing construction deal, which yielded 12 independent sections for the group, valued at over 200 million TL. Those are valuable inflation-hedged assets. And at the same time, one subsidiary, Mexis, signed a construction contract for an apartment complex in Ankara. This will result in 60 small housing units belonging to the subsidiary. They're constantly building these non-monetary assets to shield their balance sheet.
And post-period, we see continued physical expansion.
Yep. They acquired additional land parcels from the Ostim cooperative to meet their depot and logistical needs. It indicates that all this high-value manufacturing requires growing physical space to support it.
And finally, that long-running legal matter concluded this period. Good to get that off the books.
Yeah, it was important for clarity. A multi-year embezzlement and fraud case against a former employee concluded in July 2025. The court ruled against the defendants for about 3 million TL in principal debt, and the group moved swiftly, initiating execution proceedings for a total claim of 11.6 million TL. It just settles a long outstanding issue and brings resolution.
This has been an incredibly detailed look at an industrial group operating at the highest levels of specialization, all while battling a pretty unique economic headwind. The operational stability is undeniable, demonstrated by that massive 87% equity ratio and that profitable shift in their net monetary position, which provides a crucial financial buffer.
What stands out most profoundly, I think, is the pivot from volume to value. This group is succeeding not by selling more or just by high production volume, which we know is contracting, but by generating products with export unit prices that are 3, 6, sometimes 8 times higher than the national average. They have identified and executed on a high-margin, specialized industrial strength strategy. It's really impressive.
That emphasis on quality, specialization, and having a resilient capital structure, it's a powerful lesson for any company operating in a volatile market. So here's a final provocative thought for you. Given the high cost of labor and materials in Turkey's construction and manufacturing sectors, and the global slowdown affecting volume, how quickly can the group convert its consistent, extremely high export unit prices, that industrial gold, and its massive new 9.9 billion TL capital ceiling into sustained high-margin asset growth? And what specific technological niches might the Ostim GSYF Venture Fund bring in next to further elevate that high-value proposition for the whole ecosystem? Something for you to think about until the next deep dive.